I was going to say, can you tell us about your first investment property that you purchased?
Yeah, so I bought my first house at 19. And I was in university just after second year. And I had some really good scholarships that I was able to work. I worked really hard for some scholarships and bursaries that I applied for, and I got really good grades. I worked really hard for it. And I always had a job during school, and in the summers I had a good job. So I was able to save up enough down payment to buy my first house at 19. And at the time, I think it was more about, at least we bought it together, so we went half-half on it. At the time we weren't married, we were just boyfriend, girlfriend. She was going to Fanshawe, I was going to Western. So we picked a property that was at Oxford and like Warncliffe, so right there almost on the corner. And it was a little like 2-bedroom plus a den, and it wasn't a big house, it was a small house, but it was something we could afford. I was able to convince a lender to hand me a mortgage instead of, like I got approved for this Ivy line of credit thing that we get. So instead of doing that, I just self-financed. I worked to get through school debt-free. I graduated school debt-free, so I was able to, the house helped me do a lot of that, right? House happened. So my first thing at 19, I didn't really know anything about real estate other than people say real estate's a really great thing, and they say it's a great way to make money and stuff. And honestly, I overpaid for the first house. I didn't know there was no bigger pocket. There might have been bigger pockets back then, but I didn't know about it if there was. And we just bought the house. We executed on it, and then I renovated the basement, and I put a little suite in there. We rented that out, and then I got a bunch of roommates, and I added 2 more bathrooms and 2 more bedrooms. So my first renovation project, I just hired guys off the UG and I worked with them, and I learned how to renovate because I had no handy skills. I was like a nerd who gamed all day and was really studious. So I learned how to swing a hammer and use a drill and lay floor and drywall and plumbing, that sort of thing. I'm not necessarily an expert tradesperson now, but that was how I learned, right? To get from there to, I had 15 properties last year, and I sold a bunch of them off down to 4, and now I have 6. So yeah, I sold off because I wanted to downsize a bit. So having done now, I guess 19 purchases in total. So I've purchased 19 properties now today. So the first one was obviously not as good as some of the later ones that came, but it was a start, right? And that's, I guess the main point there is just sometimes do a bit of analysis, but don't get the analysis paralysis where you just wait 5 years to jump into real estate. Maybe just jump in and just do it. It's a good thing to do. You'll end up, if you do a little bit of analysis, at least you could house hack and make anything work really. So that's sort of long-winded, I apologize.
I have a really quick question. Just I'm kind of interested in hearing you go a little bit deeper in terms of the Trinity study or the 4% safe withdrawal rule that you use to get your 25 and free.
Yeah.
Because obviously, having 25 times whatever your yearly spend is in terms of your net worth to signify you're truly free, 100% passive.
Yeah.
What kind of adjustments would you make to that if somebody was, say, maybe willing to take more of a risk in terms of having freedom, or even willing to work as well? Maybe quit their job and scale back to a part-time position and kind of alter their safe withdrawal rate, I guess.
Right, so yeah, it's a good point. So part of what you talked about was the different variations of FIRE. So you can have within FIRE, there's a lean FIRE, there's a fat FIRE, which is essentially how much you're going to spend, how much you're going to live off, so you need a lot more to retire that way. There are different varying degrees of FIRE, so you can do I don't know the technical terms for this, but there's semi-FIRE, where essentially there's mini, I've heard mini FIRE. The idea of a semi-FIRE is that you continually work part-time, I believe, and so a portion of your living expenses are your basic needs. Let's say your rent and maybe your car and your food are covered by your FIRE budget, but you don't have enough to cover trips or anything you want to do in your life. So you decide to stay on your job 10 hours a week, and so you're semi-FIRE. And then mini-FIRing is the concept or idea that essentially you could work for if you're a seasonal worker, for instance, you could work for 6 months a year, save up enough to live for the whole year, and then take 6 months off and go to Costa Rica. And you could do that from day one if you wanted to. There are people who do that. I've met so many people who have variations of FIRE without even knowing it, and it's really cool to meet those guys in the wild. And
there's also firepreneurship. Matt's trying to get to catch on.
Firepreneurship, essentially, it's the idea that I don't want to watch it, but it's the idea that you're FIRE, and then you're also an entrepreneur, and you keep working and moving towards a goal, but you have that lean FIRE of your living expenses covered, so you don't have to worry about keeping the lights on if your business takes 6 months to turn a profit or something, or you want to try out some idea that you don't know if it's going to work or not. You have Lean Fire to fall back on. You have that financial independence. So that's Firepreneur. A lot of us are firepreneurs.
Yeah, and so I think the big thing with that is the biggest drawback a lot of initial people to the idea of Lean Fire get is, I don't want to live off of rice and beans for the rest of my life. And we're not saying you need to, we're saying just like get to that level, understand that you have enough, and then you're always going to be coming to life with an abundance mindset. You're always going to have just like a more positive approach to life versus the scarcity of like, it's win versus lose, when we can really build these platforms and these opportunities, particularly in a westernized democracy. We got so many head starts and advantages, let's take advantage of it. So
I think the coolest thing about it is you can take these long-term approaches to your business when you're financially independent. Because you don't need to make money today or this week or this month. You can take these long shots and try these businesses that a lot of people wouldn't normally be able to do.
I have a question. What types of investments or things do you invest in so you see, pretty much I'm assuming it says safe 4% return, so if you have $100,000, what would you invest in so you could see $4,000 a year?
Part of Dylan's question as well, that I didn't address really, was how does the Trinity study, so to withdraw 4% from our portfolio, what does that have to look like? And there are variations that can work. I think up to like 75% equities, 25% bonds can work. 90-10 is a really popular one that's outperformed 100% equities, so 90% equities, 10% bonds. Within that, you want to be diversified. That's one of the key pieces. So,
are you just talking about Canadian bonds, or?
So diversified like internationally. So I wouldn't have all my equities in Canadian equities, for instance. Same with bonds. I probably wouldn't have all my bonds in Canadian bonds.
Okay.
You can spend a lot of time building a ton of different FIRE portfolios that'll all work and all get you towards the same goal. But I think the common element you want to make sure you have to ensure that you can withdraw 4% from a portfolio and ensure that you leave enough in the portfolio grows with inflation each year. So essentially, if you're withdrawing 4%, you do like 6% roughly.
Now, are you talking about mutual funds?
So
no.
Specifically what the Trinity study, which is like what we're kind of using the 4% safe withdrawal rate based off of, you can like dive into the exact study, but it's essentially mimicking the broad market in general and a mix of equities and fixed income via bonds.
Yep.
And so essentially what it did was it went and back tested. So like we can't predict the future, that no one can, so the best thing we can do is back test. And so essentially what it did was it took various mixes of portfolios, back tested them, and found that given over a period of time, if you wanted to essentially be able to infinitely draw upon it, that to a degree of success, like let's call it like 98%.
Right.
And again, read the exact details, but essentially found that the chances of success were almost guaranteed with these certain mixes. And what's great about it is the Trinity study focused on a static spend ratio. So like it focused on a static spend ratio. So like as if you're going to spend $40,000 no matter what. And the only time that these portfolios failed in that 2% was if in the first few years you essentially had a black swan event where the market immediately nosedived and you kept spending at the same rate. But the great thing is in real life, we can all dynamically adapt to the scenario, right? So you could go and even like delivering pizza part-time and making $50 a week would drastically change your abilities based on the Trinity study. So that's what's great is that this 4% safe withdrawal rate is honestly even far safer than the average person gives it credit for, because the way our society works is we usually reward productive members of society monetarily. So to think that you're never going to be productive again for the rest of your life is kind of naive as well. So you're going to get some sort of money flow. So that's where I get real comfort with the 4%.
Okay, so it's not necessarily a guaranteed 4% you put it in,
No.
It's there for life. But you probably you might see 10% this year,
Yes.
and maybe
Yeah,
1%
so
next
we're stretching
year.
it over a long enough time period
so
that we're working out.
That's
Yeah.
okay.
Yeah, you can also, there are things you can do, 2 points. One, I want to get back to like, remind me to like, the chat that we had before I retired, because some of the advice you shared was really helpful. To helping like me realize like I actually could pull the trigger on fire. Because I remember in January like last year thinking about that, could I do it? But I spent a lot of time like fire sit and calculate. Like, there's like calculators you can go onto that you can basically forecast like whether your portfolio is going to last or not, like variables. And I remember playing with that, and I think I found that the sweet spot was a year and a half living expenses and an emergency fund. So my advice would be, if you wanted to guarantee like 100%, like 99.99% chance that it wouldn't fail, you could put like 2 years living expenses into a like Tangerine high interest savings account 2.6%. Most of the banks are offering that right now. EQ Bank does 2.4 or something right now. So that would beat EQ Bank's this online bank. But as an example, you could put like that emergency fund into something that would still beat inflation. So 2.4%, 2.6% will beat inflation. We're still earning a return on that money. We have that money sectioned off, and it's there to withdraw on in a time of recession. So essentially, like, or you could use that to double down in times of recession. So I played through a few scenarios, and it was almost impossible for the portfolio not to be like 10 times what we started at. If I like at 4% withdrawal rate using like historical data, my portfolio was growing like crazy with that emergency fund during recessions.
What types of stocks, I'm assuming you invest in stocks as well, what types of stocks or companies do you look for in terms of determining, yes, I like this company, I'm going to invest in it, as opposed to something too risky?
I have stock screens that I use to like look at stocks, and I believe in like looking at the financial statements of the company and understanding the company, but at a high level, like, I wouldn't recommend that for the average person who doesn't have that level of sophistication. Probably the best thing to do is just, like, there are some really good, like, lazy Canadian couch potato has a couple good strategies. Yale came out with like the Yale Swanson ETF portfolio. I think it's like the Yale Swanson. It might be outdated now. This is like maybe 2012, but there was a few, like, a lot of the universities came out with ETF portfolio designs they recommended. They were essentially like perfectly diversified, showing like a small percentage of the entire world equities. So you have a small piece of every company, essentially in every index in the world. And it doesn't matter if Canada fails, if US fails, if China fails, you have enough like diversification that, like, in aggregate, the data looks like you get about 6 to 7% return on average over like a long enough time horizon. So maybe up 1 year negative 10%, next year up 23%.
Right.
Hopefully, if you're diversified well enough into enough sectors, right? So if you have small, like an ETF that holds, say, pick something, like commodities, or gold, you can even hold like precious metals or Bitcoin in a very small percentage of your permanent portfolio. Essentially, if you're that diversified, it doesn't matter if a sector or industry goes down, because no one sector, no one industry, no one country is a large percentage of your portfolio. So you're essentially like recession-proof, unless the whole world's screwed, in which case we're all screwed anyway, so who cares?
So that's like a super actionable thing. You can put it in TD's E-series funds. They're like the index fund.
Okay, it's called TD.
TD E-series.
Okay.
A few of us use that. It's super low MDR fees.
Okay. Yeah, I'm looking specifically.
Index funds.
Yeah.
And then there's like Quest Trade as Vanguard ETFs. You can do Well Symbol. I posted about this in the group recently, but Well Symbol is like a low, another low fee index fund ETF. Yeah, there's a whole bunch of options like that.
Okay, yeah, no, that.
Not mutual funds in general.
Okay.
They have high MER fees.
Okay, yeah, I don't really have too much knowledge of that kind of stuff, so that's.
So the key couple things are, like, one, you want to make sure your portfolio is diversified.
Okay.
So make sure it's not just in like one stock. It's not like best practice recommendation to survive like a long term. Like, I wouldn't put my fire portfolio on that, probably. That's probably safe advice. I shouldn't give any advice unless this is recording. Like, anything I'm saying is my opinion. Don't trust, like, don't sue me. Yeah, like, I do have like a small percentage of my portfolio of play money that I put into like stocks and things like that. And I do like to play a little bit. So if you're a sophisticated investor, we can chat after about like techniques that I've used to like pick different stocks. And at the end of the day, like what we know is that I actually took a wealth management class in my 4th year of Ivy, and it walked through the whole fee debate, right? Whether you could buy into a mutual fund, active fund managers, so like there's active management and passive management, right? Passive management, ETFs leverage like AI, leverage like basically have computers do a lot of the work, and active funds like mutual funds tend to be hedge funds and those things. They're run by people. People are working, they're paid great salaries, they take management fees. So the average MER in like Canada is like 2.3%, and the average MER on like the passive side, if you're looking at low cost stuff, like not even TD series, but like Vanguard, like super like ones you buy in discount brokerage, right? You can open like a Quest Trade account or interactive brokers account and buy those symbols, those ETFs, stock symbols, those tickers. Those ones tend to have like a quarter percent roughly of MER. So that difference essentially over like a long period of time, basically like if you were to compound that, right? That's a ton of money. Like on $1 million portfolio, we're talking like $1 million over $1 million in fees over a lifetime. So it's a huge. The active fund managers have a huge amount of extra value that they bring to the table to justify that, right? And if you look at the data in aggregate, in summer, I think it was like, it depends on the country, right? Certain countries, like one like Norway, where like 99.9% of fund managers over a 25-year period, net of fees, have underperformed their index. That means they should all be fired, in my opinion. Like, why do they even exist? If they can't outperform the index they're benchmarked to, why are they here? So that's something that, like, reading those sorts of studies in the wealth management class got me thinking, like, wow, humans are actually not that good. And like, we as investors, we think we're really good at investing, and we all have our own strategies for like, I'm taking value investing classes, and I think that I can pick stocks better than even some of the pros. And like, truth be told, I probably can't over a long period of time. Over a 15, 20-year horizon, you're probably better off to buy an index than try to beat the index. We just don't have that. Even like guys who have this sophisticated knowledge, and they have that, all those resources at their fingertips. They know when things are happening as they're happening. Even those guys can't beat the S&P 500, right? Most of the I think it's like 90-something% of mutual funds underperform the S&P 500 over like a 10-year time horizon even. So I don't know how, like in Canada, it's a $1 billion industry. It's huge. I don't want to like shit on mutual funds, but like, yeah. I mean, you get a lot of other things when you buy that from an investor, from an advisor. It brings you like a lot of other values.
Oh, great. I was wondering if you passed your number, you doubled your number, where do you stop? How come you're still in real estate?
When is enough enough?
Yeah.
That's a good question. It's a great question, Laura. Enough is enough when I can do whatever I want. No, that's a bad answer. I guess like it just depends on your goals, right? I think a lot of us who got to, and Matt said something impactful to me before I pulled the trigger. He said something like, "You're able to get where you've been able to get this far at this age, right? Unlock whatever you've been able to unlock. Do you actually honestly think you're not going to be able to produce more value going forward? Like, do you actually think you're going to need to rely on this portfolio?" And like that, for some reason, that just stuck with me and it still sticks with me today. Like, no matter what happens, we're going to be safe. And like, I know that I'll always have enough, so I don't need to push myself. I don't need to go and like grind hard on the rentals. I sort of enjoy it a little bit. Like, I enjoy the punishment, I think. It's sort of like a twisted, like, truthful answer. I'm kind of twisted that way. Maybe I just enjoy putting myself in harm's way. I don't know. When is enough enough? I just like being like, what happens if something changes? And I'm super like, I do a lot of planning, and I'm up in here a lot. At night even, like I'm in bed, I'm up here a lot, and I'm just thinking, well, what if this happened? Or like this crazy scenario happened, and like, what if I couldn't adapt? And I want to make sure I have like more than enough. I want like 2% safe withdrawal rate. And so that's why like,
Where your worst case scenario is you go back to your job.
yeah, and it's irrational, and I know it, and like I know I'll be fine, and like, yeah, when is enough enough? I don't know. I'm gonna probably keep growing until I have, if I stay on the path that I'm on now, and I grow at my slowest growth rate of the last 5 years. I picked the worst year, and I grow at that rate now until I'm like 45, I'll have $100 million. And that's like 12% growth. Like if I grow at 12%, like I'll have like 100 million if I just keep growing. Like it gets harder to grow as you get bigger. Hard to find deals and you have like $50 million to allocate. But theoretically speaking, I could just keep growing it. I don't know when enough is enough.
I have a follow-up for that. Now, can I buy into a percentage of that 100 million? Because I don't want to do anything. I just want to put, you know what I mean?
This is why hard money lends. So like my current portfolio exists.